Good evening, dear viewers, and welcome to the Inderes Life Science Night. My name is Antti Siltanen. I'm an equity analyst and an analyst focused on life science equities. I will be giving the opening remarks tonight and also moderating the questions, so please keep sending your questions to the companies via the chat function. So let's take a look at the listed life science companies in Finland. Basically, we have about 15 listed companies. They can be roughly split to two categories: pharma and drug development companies and health technology companies. So from the two drug development companies, both Faron Pharmaceuticals and Herantis Pharma are presenting here tonight. We have one slightly bigger pharma company, Orion, and Nanoform, who are developing drug formulations for existing drugs. From the health technology sector, we have Aiforia Technologies, who are developing artificial intelligence solutions for digital pathology. We have companies from orthopedics, ophthalmology, neurostimulation, biomedical lasers, diagnostics, imaging, and biosignaling measurements. If you look at the profile of these companies as a whole, they're mostly early-stage small-cap companies. So about half of the companies' market cap is above 100 million euros, and only a few companies have revenues higher than 100 million. So the profile is early stage. Some of the characteristics of life science companies as investment. So firstly, these companies are often stemming from academia and commercializing innovations, and sometimes because of these companies are perceived as difficult to understand, but we do our best to kind of inform investors and help to make informed decisions on these companies. The environment is usually strongly regulated, so the companies need to get marketing authorization from the regulators, and that often takes a lot of time and effort to get there. The market usually, once the companies access the market, the market is usually global and somewhat conservative. So the doctors, who are typically the customers, they are very careful to only accept very high quality, effective, and safe treatments and products for their patients. And early stage companies typically have very high potential, they are risky and usually unprofitable. And when the companies get to mature stage, they are often very defensive and highly profitable. So when young companies are accessing markets, they have some barriers to get to the market. So one major barrier are R&D risks. So for example, if a drug candidate is not effective enough, the development program may be ended before market authorization. By funding, the companies usually need large upfront investments, so a lot of funding is required upfront. And the market, as mentioned, is a little bit conservative, so new innovations are usually a little bit slowly taken up by the market. But once these young companies turn into more mature companies, these barriers become moats. So more mature companies are often highly profitable and have a very defensive position. There are some very strong trends behind the life science companies. Typically, aging population is increasing the number of patients all the time by a few % each year, who are increasingly needing products and services by health tech and pharma. The need for new treatments is always high and increasing. There's always need for more safer, more effective treatments and medications. There's also increasing pressure on budgets in developing countries, so cost-saving solutions are coming increasingly important. When we look at the big picture, both the pharmaceutical market and medical technology markets are huge. They are growing at about 5% per year annually, and it's a very defensive and predictable growth. So what does a strong life science company look like? one indication of an excellent company is that it has a value-adding product for both patients and other stakeholders, and it usually has already market authorization and strong IPR for the products. It's an advantage if the company is first to market, but this is not necessary. But if a company is not first to market, it has to show improved efficacy, safety, and or cost savings to then win the existing solutions and gain competitive edge. Financials for growth is secured for a strong company, and this enables the company to focus on its growth strategy and kind of in other ways the company management may need to kind of put a lot of focus on gathering funding. And sales and marketing capabilities need to be in place to be able to then grow with an excellent product. So if you look at the funding environment, there has been some quite big changes over the past few years. So following the COVID crisis, there was kind of a liquidity surge to the market, which showed in 2020 and 2021 in increased funding and in increased numbers of IPOs. And since then, after the increase in inflation, an increase in interest rates, there have been quite a quick slowdown in funding, which is now slowly getting better, but still at a lower level compared to the previous years. So for funding of the companies, as mentioned, the companies usually have lengthy R&D and regulatory pathways, which take up a lot of funding. So it's essential to have strong funding. The growth, once the company gets to market, the growth typically realizes over time, first by the first product and then through indication expansion and broadening of the product portfolio. But this usually takes a number of years to then reach cash flow positivity. Then at mature stage, those companies that are kind of big and dominating the market, they are generating a lot of cash, and they're usually quite hungry for innovation and looking for smaller companies to buy. And this creates potential for the small companies, for M&As and lucrative licensing deals. So in terms of valuation, as expected, the early stage companies are typically loss-making. This means that we cannot use for valuation earnings multiples. So typical tools are net present cash flow calculations by DCF or discounted cash flow models. And then often we also look at the revenue-based multiples for those companies that are generating revenue. And we also look at the sector peers to compare valuations to other similar companies in the field. Because of this limited tool set, the valuation by definitions is a little bit less accurate compared to more mature stage companies. And the multiples that we are seeing, for example, in revenue-based multiples, they are typically quite high because the companies have big potential for both growth and earnings potential. But this also creates risk when you combine negative cash flows with high multiples. We think timing matters when investing in early stage companies. So there are usually high growth expectations combined with high multiples, and sometimes a conservative uptake of innovations into the market. Also, cash flows are often negative, which creates need for share issues or other funding rounds and pressure to increase the number of shares. Here's one example of a company called Tela Bio. They IPO'd in 2011. They have been growing very fast, but unfortunately the share return has not been good because of increase in share numbers. But then more positive case here, Kuros Biosciences. They have also grown rapidly during the past few years, and once they kind of started to reach cash flow turnaround, their stock became a 10 bagger in a matter of 12 months. So this kind of highlights the excellent potential in investing in these companies. So to sum up some of the strengths and opportunities for life science stocks, they are usually going straight to the global market that are growing and very, very defensive markets. The R&D pipeline, once the company has success in commercializing the products and getting regulatory approvals, winning market share, that creates moats for the companies, and they have usually very strong position in the market by then. There's really good potential for high profitability. Typically, gross margins are very high, and also the companies have usually low capital requirements once in the commercial stage. There's potential for being M&A targets and also landing lucrative licensing agreements. And in the long term, there's usually possibility for very long-term profitable growth, and the customer stickiness is very high because of the defensiveness. And some weaknesses and threats in the markets. The R&D risk, especially for biotech companies, may be very high. So if, for example, the efficacy of a drug candidate is not good enough, the asset may be written down. Market authorizations are sometimes lengthy, and that's a barrier to market. There's a need for upfront investments, as mentioned, and the revenue growth is sometimes very gradual, taking a few years to reach cash flow positivity. And at some point there will be competition via new innovations. Thank you very much for listening, and let's take our first company, Aiforia Technologies.